Hello and welcome back to Dukascopy TV. Now joining me back in the studio is one of our regular guests, Gavin Pluck from Guardian Wealth Management. Gavin, thank you very much for coming into the studio
Natalie.
today. Now we're going to discuss FATCA today. Can you just give us a little bit more background on this?
Well, Natalie, FATCA, which stands for Foreign Account Tax Compliance Act, was actually written into US law in 2010 with the idea of being implemented in 2013, January 2013, which is obviously only a couple of months away now. The reason behind FATCA was really prevention, to prevent US citizens from holding foreign non-US accounts and non-US investments in non-US investment houses, really with the potential of evading taxes. Now, the IRS have calculated that up to $800 million per annum has been lost in revenue through to Americans holding non-US accounts. And what they've really tried to do is, with the intention, which is similar to the EU Tax Savings Directive, which was implemented in 2005, which enabled EU countries to exchange information for tax purposes. That was the idea behind FATCA, but FATCA is a lot more complex and punitive than the USDD, in as much as, I suppose, any American holding a non-qualified account or a non-disclosed account could be subject to penalties of up to 40% of the revenue on that investment in a year on year. Likewise, any financial institution that may not be regulated or approved through FATCA could stand a withholding penalty of up to 30% in revenue derived from US income.
How then does this impact on the workings of non-US financial organisations such as Guardian Wealth Management, and how is it affecting US citizens that are living abroad? Well,
since FATCA was introduced, there's been widespread confusion, I think, which has sort of resulted in concern, panic to a certain degree, not just in US expats, but also foreign financial institutions who, through a lack of information and lack of understanding into how FATCA is going to be implemented, have taken the extreme short-term steps in closing accounts to American citizens, in as much as, many have been refused very basic bank accounts as well. And you can understand it from the point of view of an American citizen living abroad. They probably feel that they've been left out in the cold as an afterthought here, where they are going to struggle. They're going to be financially alienated by financial institutions based in the countries that they live in, which doesn't make for an easy life if you're an expat wanting to live outside of the USA. This has been a real concern with a number of groups, a number of US citizens groups who have lobbied FATCA quite vigorously in order to really oppose this and try and get it repealed, because it has, one key figure that I spoke to, who is a member of American Citizens Abroad, likened it to US citizens sitting on the Titanic watching it heading towards an iceberg and no one else doing anything about it apart from them jumping up and shouting. So you can understand it's a very difficult scenario for those Americans living internationally.
You mentioned at the start of this interview that this is all coming into implementation in 2013. What do you think are going to be the next steps to enforce this?
Well, it's a difficult question to answer at the moment. Maybe if you'd asked me that a couple of weeks ago. But last week, the US Treasury put a statement out saying that for any country that hasn't signed an intergovernmental agreement to date, they're going to extend the deadline up to 2017, which is, the statement was very vague, which I can imagine could be very confusing for a lot of countries and governments involved. For example, Switzerland, they have agreed to sign the IGA with the US Treasury, but what hasn't been confirmed is the parameters and the rules surrounding that. So would Switzerland qualify for an extension on this? As much as companies, you ask questions sort of like, how does it affect companies such as Guardian, we have obviously got a number of US clients, and unlike the banks, we want to keep the doors open to these clients. So we've worked quite hard over the last 6 months to a year to try and find a solution which is going to be FATCA compliant. Our clients, they're not looking to evade tax, and likewise they don't want to really pay 40% on the income on their investments. So that's our focus that's been our focus recently, really trying to find the right solution so we can keep the doors open to American clients. How things are going to change, personally I don't believe it will be repealed. However, changes have to be made, because if we carry on the train on the speed that we're going, I can't see any large investment banks or smaller financial institutions for that matter having all their ducks in a row by January 2013. Something has got to change. As well as that, I believe that there has to be a completely different threshold for US expats. So anyone that's living outside of the States, they've got to have a different threshold, because they live in they live in a different country. They have to invest in local. They're going to invest in local banks. So the threshold, which currently stands at $50,000 US dollars, there's been talk of increasing that. I'd imagine that would have to be increased to quite a high degree.
Gavin, thank you very much for talking to us about this topic. I feel it's definitely not going to be the last we hear on something like this, so thank you very much. That does bring us on quite nicely to the Dukescopy question that we ask our guests at the end of each interview, and it is, if you had $1 million US dollars to invest for 1 year, where would you place it? So if we have a look at the board, you can see our options for today. We've got real estate, equity, bonds, gold, cash and oil. So that's $1 million US dollars for 1 year. Gavin, where would you place it?
For 1 year only, right? Okay.
Just 1 year.
Right. Okay, well, I'll take real estate out of that equation. Equity, bonds, gold, cash. I mean, obviously, it would depend very much on one's attitude to risk. And if I'm talking about myself, if I'm looking at the markets where they are at the moment, equity is generally seen as a fairly scary place at the moment. But I would probably say, if I had to invest, I would go for equities. Now, there are certain types of equities. It doesn't mean mainstream equities across the board, but I think there are some very cheap or reasonable stocks out there at the moment, well worth purchasing. So I'd look into that, but I would have to say equities.
Gavin, thank you so much for coming into the studio. We look forward to seeing you again soon.
Thanks, Natalie.
Stay tuned to Dukescopy TV for more exclusive interviews. For now though, goodbye.